Order blocks are a widely recognized idea inside the smart money concept. This video serves as a complete guide on order blocks, where we'll discuss everything from fundamentals to advanced methods, step by step. We'll explore this subject in this video, so let's begin. But before moving forward, if you are new to our channel, then press the like button and subscribe to our channel so you don't miss our future videos. I'll meet you right after the intro and disclaimer. So, first, let's learn what an order block means. An order block is an important region where institutional traders, including banks and hedge funds, execute massive orders, also called smart money. This area behaves like support or resistance in the market. Whenever the price returns to this region, the market is more likely to turn bullish or bearish. There are two categories of order blocks: a bullish order block and a bearish order block. The first one is a bullish order block. A bullish order block develops when heavy buy orders are executed in the market. When the market is rising, forming a swing, the last bearish candle becomes the bullish order block. When the price returns to the zone of this bearish candle, the bears react again, and the price shifts back to a bullish movement. Second, bearish order block. A bearish order block appears when massive sell orders are executed in the market. When the price swings, if the order block exists in a downtrend, the last bullish candle becomes the bearish order block. Whenever the price retests the zone of this bullish candle, sellers activate again, and the price moves downward. Now we've seen how many types of order blocks exist, but it's equally necessary to recognize which order blocks are valid and which are invalid. To recognize valid and invalid order blocks, we must follow four essential rules. First, liquidity sweep. If the price breaks the high or low of the previous candle where traders placed stop losses before the order block appears, it's called a liquidity sweep. This indicates the institution collected liquidity from there, and the order block created afterward is a valid order block. However, if the price doesn't break the high or low of the previous candle, it is seen as an invalid order block. Second, imbalance or fair value gap. A genuine order block is followed by a strong impulsive movement, forming a gap known as FVG, fair value gap. If there's a gap between the first and third candles in a three-candle formation, it is a valid order block. However, if the price after the order block moves slowly or sideways, and no strong movement or gap appears, then there is no imbalance, and such an order block becomes an invalid order block. Third, unmitigated. If the price retraces for the first time after the order block forms, it is fresh or unmitigated, and such order blocks are extremely strong. However, if the price has already tested the order block zone several times, then the order block becomes mitigated. This means the order block has already been consumed, and the chances of a strong reaction reduce. For this reason, we label such an order block as an invalid order block. Fourth, market structure break. If a clear break of structure or shift of character is visible in the market after the order block, it is treated as a valid order block. A break of structure signals trend continuation, and a change of character signals trend reversal. If the price stays trapped in a range after the order block or no clear higher high or higher low breaks occur, the structure is not valid. You just learned that four rules must be fulfilled to create a valid order block. Fulfillment is essential. This includes liquidity sweeps, fair value gaps, unmitigated zones, and market structure breaks. Now, let's move to the strategy. The strategy is simple. We use two time frames. First, a higher time frame. In this higher time frame, we identify market direction and order blocks. Second, a lower time frame, where we plan confirmation and entry. Market direction, meaning whether the market is dropping or rising. If the market is in an uptrend, we identify bullish order blocks, usually the final bearish candle before the upward move. We'll also verify that the order block we're studying is a valid order block. Then, we wait for the price to return to that correct order block zone. When the price comes back to the order block zone, we immediately switch to a lower time frame for confirmation. In the lower time frame, we'll wait for a change in market character. Once the change of character appears, we identify the order block based on the trend and place our entry from there. Remember that the entry time frame should always be at least 2x smaller than the analyzed time frame. For example, if you're analyzing on a 4-hour chart, you use a 15-minute chart for entry. You can mix combinations. Now, let's inspect the chart. This is a 4-hour chart of Bitcoin. Our higher timeframe market shows a clean uptrend, with the market making higher highs and higher lows and moving upward. Now, we examine whether this order block is valid. To do this, we apply 4 rules: liquidity sweep, fair value gap, unmitigated zone, and market structure break. All these conditions align, so this area becomes our valid order block. Now, we just wait for the price to touch this area again. Now, we switch to the 15-minute chart for confirmation and entry on the lower time frame. The 15-minute chart still shows a downward trend, so we must wait for a change in character. A change in character happens when a swing break occurs. This means the downtrend ends, and the market could push higher. We will locate a new order block within the bullish move that formed after the change of character. Our stop loss will be placed on the entry order block, slightly below the order block area, and our first target will be at a 1 to 2 risk to reward level. We will close half the position. The second target will be either the structure or a trailing one. If the market continues advancing and you require more entries, you can enter through another order block. As you can see, there's an order block here. You can enter here. However, for careful risk management, you should take the first trade with a 2% risk. The second and third trades are at 1%. This is a 15-minute chart. Here we'll use the higher time frame, 15 minutes, and the lower time frame, 1 minute. You can see that the market is showing a downtrend, with an imbalance and a break of structure. Now, we mark a valid order block here. When the price touches the zone in the order block, we switch to the 1-minute time frame to get confirmation. A change of character has already happened here. Now, we'll locate the recent order block and place a sell order there. The entry will be on our order block. The stop loss is above the order block, and the target is at the market structure. If the price builds a new order block, you can take more trades, but with reduced risk. Guys, this strategy is very powerful, but just learning it doesn't make you profitable. You must practice it. The strategy must be backtested. It must be checked on multiple stocks and currency pairs, and most importantly, proper risk management must be practiced. That's it, traders. Thanks for watching this video. Most people limit themselves before the world ever does. If this video helped you believe a little bigger, hit that like button. And if you're new here, subscribe and turn on the notification bell so you never miss the lessons built to strengthen your mindset. Your goals aren't out of reach, you just haven't stretched far enough yet. Keep moving, keep learning, and keep trusting your process. Growth takes time, but regret lasts forever. Stay rising, and I'll catch you in the next video.